We're doing fine with China. We're doing fine with I think almost every country. Everybody wants to have involvement with the United States. 145% is very high, and it won't be that high. We were talking about fentanyl, where various elements built it up to 145. No, it won't be anywhere near that high. It'll come down substantially, but it won't be zero.
Let me be clear. There will be no unilateral reduction in tariffs against China. The president has made it clear China needs to make a deal with the United States of America, and we are optimistic that will happen. And when that continues, it'll be up to the president what the tariff rate on China will be. But we certainly need to see a reduction in tariffs and non-monetary tariff barriers from China as well. And we also need to continue seeing these companies abroad return their manufacturing to the United States of America so we can shore up these critical supply chains. Okay.
In Washington, a dramatic shift is underway in the United States trade war with China. The Trump administration has suddenly rolled back its harshest tariffs on Chinese imports, marking a stunning U-turn from the aggressive stance it took just weeks ago. Those tariffs had soared as high as 245% on some goods, rattling the global economy. Now, officials say duties will be scaled down to a more moderate 50% to 65% range, still high, but a far cry from the earlier extremes. This unexpected reversal follows weeks of economic turbulence and diplomatic brinkmanship that left markets reeling and governments worldwide on edge. It was only a short time ago that President Donald Trump jolted global commerce by unleashing unprecedented tariffs against China. In an effort to pressure Beijing over what he called unfair trade practices, the White House imposed sweeping new duties at rates never seen before in modern trade. Virtually all imports were suddenly hit with a blanket 10% tariff, and Chinese products faced punitive rates up to 245%. This aggressive move shocked financial markets. Investors worldwide scrambled as the tariffs took effect, fearing higher costs and slower growth. Stock markets plunged for days, wiping out trillions of dollars in value. Over the course of a single week, an estimated $6 trillion was erased from global stock indices as panic set in. U.S. bond markets and the dollar were also shaken by the uncertainty, and economists began warning that a global recession could be on the horizon if the trade war escalated further. Businesses large and small felt the impact immediately. American manufacturers and retailers, reliant on Chinese components and goods, warned that costs would skyrocket and likely be passed on to consumers. Within days, consumer confidence indicators in the U.S. fell sharply. Some surveys showed Americans becoming as pessimistic about the economy as they were during the 2020 pandemic. Supply chains that had functioned for decades were suddenly in disarray as companies hastily sought alternatives. Allies and trading partners around the world watched in alarm at the escalating trade conflict. The turmoil grew so severe that even U.S. allies like Japan and Canada signaled they might step in to stabilize markets, an extraordinary role reversal, since the United States usually takes the lead in shoring up global financial stability. Beijing was swift to retaliate. China's government answered Trump's tariff salvo with steep tariffs of its own on American exports, reportedly as high as 125%. It targeted key sectors of the U.S. economy. Everything from agricultural products like soybeans and pork to manufactured goods and automobiles was caught in the crossfire. This move was calibrated to put political pressure on Washington by inflicting pain on American farmers and industries, many of which are part of Trump's political base. Chinese state media struck a defiant tone, declaring that China will not bow to external pressure and is prepared to endure short-term pain to defend its economic interests. The tit-for-tat measures created an atmosphere of escalating crisis, and trade talks that once seemed possible were suddenly frozen. Other countries in Asia, from South Korea to India, braced themselves for ripple effects as global supply chains adjusted. Global trade volumes began to contract amid the uncertainty, and economists slashed growth forecasts for 2025 in many nations. The message from Beijing was clear: if the US was going to hit China with record-high tariffs, China would hit back in kind. This only intensified fears that the world's two largest economies were careening toward an all-out trade war with no easy exit. Inside the White House, the fallout from the tariff escalation did not go unnoticed. As global markets nosedived and headlines warned of economic catastrophe, pressure mounted on the Trump administration to rethink its approach. U.S. businesses lobbied intensely for relief, and even some Republican lawmakers, normally loyal to the president, voiced concern about the damage being done to the economy. Initially, President Trump and his team doubled down on their hard line. The president publicly dismissed the market panic as an overreaction, even urging investors to be cool and insisting that everything will work out well. But those reassurances did little to calm the chaos. Behind closed doors, aides grew increasingly alarmed at the volatility. Reports began to surface that a policy rethink was underway. By mid-April, rumors swirled that the administration was considering a pause or reduction in tariffs to stabilize the situation. The White House officially denied any change of heart. At first, a spokesperson labeled such talk pure speculation, unless it came directly from Trump himself. Yet the sheer scale of the market sell-off and the risk to the US economy were clearly weighing on the president. For the first time, flexibility, a word rarely associated with Trump's trade stance, was on the table. Then came the historic about-face. In a surprise announcement, President Trump declared that the United States would roll back many of the tariffs that had been imposed just weeks earlier. Effective immediately, the extreme country-specific duties were put on hold and a new, more moderate schedule was introduced. The most striking change was aimed at China. Tariffs on Chinese imports, which had been as high as 245%, will be slashed to roughly 50 to 65%. That is still a very high tariff by ordinary standards, but it represents a dramatic retreat from the previous peak. In essence, the White House hit the pause button on its trade war escalation. Trump framed the move not as a concession but as a strategic recalibration. Flanked by his economic advisors in the Oval Office, he argued that his hardball tactics had forced other nations to the negotiating table, and that easing up now would help secure better deals in the long run. "You have to be flexible," the president admitted, a startling remark from a leader who had repeatedly vowed never to back down. Officials were quick to note that this reversal is not an absolute end to the trade fight. A 10% blanket tariff on most imports will remain, and existing duties on steel, aluminum, and some other products are still in force. But the harshest penalties are being lifted for now, creating a 90-day window for negotiations, a signal to Beijing and other capitals to also hold off on retaliatory measures and come to the table. The response from global markets was instant and euphoric. Within minutes of the rollback news, stock prices began to soar. On Wall Street, major indices that had been deep in the red rebounded dramatically. The benchmark S&P 500 erased a large portion of its recent losses, and in Asia, Japan's Nikkei index and other exchanges surged on the welcome news. The US dollar, which had been sagging as investors sought safer assets, stabilized and began to climb again. By day's end, some analysts were calling it a historic rally, a sharp reversal fueled by relief that the worst-case scenario had been averted. Business leaders also applauded the de-escalation. Industry groups representing manufacturers, farmers, and retailers praised the tariff reduction while cautioning that uncertainty remains until a formal agreement is reached. Economists noted that lowering tariffs should help support growth and reduce inflationary pressures. However, they pointed out that even at 50 to 65%, the tariffs on Chinese goods are extraordinarily high, meaning trade flows will still be far from normal, and some prices will stay elevated. Still, confidence has been partially restored. Companies are breathing a sigh of relief that the situation didn't escalate further, although planning for the future continues to be difficult amid such rapid shifts in policy. One market strategist described the situation as causing a kind of whiplash effect for businesses, but he added that even a turbulent calm is preferable to an uncontrolled trade war. Foreign governments reacted with cautious optimism. Allies in Europe and Asia, who had been urging restraint, welcomed the news that Washington and Beijing might be stepping back from the brink. There is, however, lingering skepticism. Given the Trump administration's history of abrupt policy shifts, many partners are unsure how long this truce will last. They have just witnessed the White House make a 180-degree turn in a matter of days, which raises questions about what might come next. For now, though, global leaders are encouraging the US and China to use this opportunity to negotiate a more lasting settlement and bring an end to the damaging cycle of tit-for-tat measures. All eyes are now on China's next move. Beijing's initial response to the US rollback has been relatively muted, although tinged with cautious optimism. Chinese officials say they welcome steps that lower tensions, but they also emphasize that core issues in the trade dispute remain unresolved. For now, China's retaliatory tariffs, up to 125% on US imports, remain in effect. Analysts expect Beijing to adopt a wait-and-see approach. It will likely verify that Washington follows through on its tariff cuts, and perhaps addresses other sticking points like technology restrictions, before scaling back any of its own measures. For President Xi Jinping, any concession to the US must be balanced against the risk of appearing weak at home. Still, Chinese state media have begun hinting at the possibility of renewed negotiations, asserting that dialogue is feasible if conducted on an equal footing. In short, China appears cautiously open to talks but is not making the first move until it's confident the US is truly dialing down the pressure. Meanwhile, other countries are evaluating the impact of this shift, and perhaps none more so than India. As a major emerging economy, India could benefit in certain ways from the US-China trade rift. Global companies diversifying their supply chains away from China have been eyeing India as an alternative manufacturing base. Indeed, during the height of the tariff conflict, the US and India made headway in their own trade negotiations. A high-level American delegation's recent meeting with Indian Prime Minister Narendra Modi reportedly yielded progress toward a bilateral trade deal. Analysts see this warming of US-India ties as part of Washington's strategy to strengthen partnerships with countries like India and reduce reliance on China. However, India is also vulnerable to the broader fallout from a US-China economic conflict. The tariff war had begun disrupting supply chains that Indian industries rely on, and a deeper global slowdown could hurt the country's export sector. That's why New Delhi has been relieved to see Washington and Beijing step back from further escalation. A more stable US-China trade relationship will support global growth, which in turn bolsters India's own economic prospects. Additionally, de-escalation means India faces less pressure to choose sides between the two major powers, allowing it to maintain balanced relations with both. In short, India, like most nations, would prefer a swift resolution to the US-China trade dispute, even as it keeps an eye out for opportunities arising from any realignment in global trade flows. Tonight, the world may be breathing a little easier knowing that the United States and China have stepped back from the brink of an all-out trade war. But this conflict is far from over. In the coming weeks, negotiators from Washington and Beijing will attempt to translate this truce into a more lasting agreement. The big question now is whether this fragile ceasefire will hold. Will both sides use this moment to find common ground, or is this merely a temporary pause before another flare-up in tensions? For the global economy, the stakes are enormous. If Washington and Beijing can hammer out a durable deal to dial back tariffs further, it could reinvigorate confidence and boost growth worldwide. Companies might resume investing and hiring with less fear of sudden supply shocks, and countries from Germany to India would benefit from a more predictable trade environment. But if negotiations falter, tariff threats could quickly return, and so would market turmoil and recession fears. For now, the Trump administration's change of course has averted the worst-case scenario. It's a stark reminder of how interconnected today's economies are. Decisions made in Washington and Beijing can send shockwaves from Wall Street to Shanghai to New Delhi. The coming months will test whether this tentative truce can evolve into a lasting peace on the trade front. Global markets, businesses, and billions of people around the world will be watching closely to see what happens next in this high-stakes economic drama. Thank you for watching, and stay tuned for further updates on this developing story.